So the market, man, it's riding a roller coaster. And people are asking, is yesterday's rally a good sign of things to come? Or is it not time to breathe yet? Should we be holding our breath? Joe Krier, president of Krier Wealth Management, back here on the morning show. So Ben Bernanke speaks. People apparently listen. Is it unprecedented to have such a quick reaction that shows a major reversal in the market?
I tell you, in these times when emotions are running wild, small factors are having big effects. And this was actually kind of an official statement. So just as S&P's downgrade was an official downgrade versus all the rhetoric we've been hearing for the last month in the debt debate, well, Bernanke's statement yesterday was an official statement that we're going to keep interest rates low.
You talked about the emotional reaction. As somebody who is a financial advisor, does that emotion worry you? Because, you know, you make decisions for the long term.
Yeah, it does. It does. And, you know, these are massive short-term swings. And, you know, at times like these, what we have to do and what your viewers ought to do is kind of sit back and say, whoa, wait a minute. It's like I tell my high school kids in their high school politics, just kind of rise above it and things will settle down over time. And that's what's going to happen in the market. In the meantime, you know, this is the kind of stuff that raises a hair on the back of your neck.
Is that why you say this is a double-edged sword?
Yes and no. And part of why I'm saying it's a double-edged sword is that the only reason that the Feds would keep interest rates low through 2013 would mean that the economy is in a lousy spot until 2013. And, you know, we need things to get moving here. And actually signs of interest rates going up just a little bit would be better than maintaining this sort of, you know, bottom of the barrel lookout.
Let's talk about some of the fundamentals in all of this. Why do investment prices change?
Two reasons in the short run, you know, that make things change here. One is expectations of future earnings change a little bit. So if you're expecting a company to make $10 per share per year and all of a sudden that goes down to $8, well, you have to adjust your price. And then the other thing is what I call the fear-greed pendulum, you know, where risk tolerance changes. And, you know, people have been absorbing a lot of risk all through the year, and all of a sudden, you know, a downgrade or getting past the debt ceiling debate and seeing that, hey, maybe this deal wasn't anything that's going to impact anything immediately anyways. People just had enough, and all of a sudden they spun out of control.
So let's talk about those fears. Is it fueling the roller coaster ride? And the fact that we've got cumulative fears making matters even worse.
Yeah, it's definitely fueling the ride, and people are trying to factor in extremes here, you know, and the extreme as far as the market falling apart is that everything goes into lockdown mode like it did in 2008. I just don't see that happening. You know, you've got the U.S. economy slow, the global economy slowing. Europeans' debt problems are much bigger than ours, and they're right up at the precipice. And of course, it feels like Washington can't get anything done. Put all that together, you've got a mess for some big-time volatility.
The irony there is the president's trying to set a certain tone, and it's really not working. Hear a lot about stocks. What about the bond market?
Yeah, the bond market's been quite calm through all of this, you know, and when S&P downgraded U.S. Treasury bonds, you know, that was the thing that you would think would be most affected, but actually Treasury bonds have rallied for the last week steadily. And as an example, Germany's bonds have a higher rating than ours right now, but for the last 3 days, people have been dumping German bonds and buying U.S. Treasuries. So, you know, something's out of kilter here. It's got to straighten itself out.
Yeah. Let's get to the bottom line here. People sit back and they say, okay, we dumped 600 plus points one day, up 400 plus the next day. Are we out of the woods, or is the bottom line really anybody that tells you they know what's going to happen is full of baloney?
The last thing you said there, yeah, we're all full of baloney if we're going to try to tell you one day to the next. No one knows what's going to happen one day. In the end, you kind of have to back away from it. And, you know, a slow-growing economy is better than a recessionary economy. That's the big question on the table. And can corporate earnings continue to go up? At this point, that looks like a yes. So,
and that's no baloney.
Yeah, when this settles down, we could be okay.
Joe Krier from Krier Financial Wealth. Thanks very much for being here. Appreciate it.